Hi, good morning, everyone. Morning, good morning. Put the comments up, so if you're tuning in, you can drop a comment there. And we will wait just a few minutes here to get started, wait for everybody to have a chance to jump on and wait to go live on all the different platforms here. Looks like the comments aren't coming through for some reason.
I can't see them.
Yeah, there's an error on the comments because I see the comments coming in on YouTube, but that's okay, no worries. Keep dropping your comments. We can see them on YouTube, just not here in the streamer. But we'll just wait just a couple seconds here to get started, so hang tight. All right. Looks like we are live on all of the different platforms, so I think we can go ahead and get started here. So, welcome everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator. I am joined here by Nick Hiersche, our president, and Jose Gonzalez, our sales manager. Now, what we do here every day at 11 a.m. Eastern time is we go through the rates of all of the different programs that we offer. We can quote them instantly and pull up the pricing for you to check them out. And then we do a deep dive into a specific topic. And today's topic is going to be short-term rental DSCR loans, debt service coverage ratio loans for short-term rentals. So we'll have Jose do a deep dive into that in a little bit, but first we'll do what we do every day, which is pull up the rates. So Nick can go ahead and take our rate tool here, pull it up, and go through some of the different rates. We'll check it out, compare it to yesterday, and we'll go from there. So go ahead and take it away, Nick.
Alrighty. So let me go ahead and pull up our rate tool. Let me switch my screens real quick. And we will get started. All right. So here is our rate tool. This is for our mortgage professionals. We have over 350 loan officers and licensed in 21 different states for primary and second homes. And we can do our DSCR business purpose loans, which we'll talk about here in a minute with Jose, in pretty much every state. So we're going to go through a couple scenarios today. This is just the pricing for today. It is March 1st, just after 11 a.m. Eastern. So all of our basic programs are live with our pricer here now. So we will check out what we have in the marketplace today. If you'd like a full loan estimate, please get with our team members. This is just a pricer with the indication of pricing today. Our team can give you a full breakdown loan estimate with all the costs and details. So let's set up a few quick scenarios. We're always going to do every morning our conforming, our conventional programs. We're going to compare those with our FHA programs as well, which is usually the second option. And then fortunately here at the Mortgage Calculator, we have over 4,500 loan programs under expanded guidelines. Those are our non-QM loan programs, which we absolutely love here. We also have VA and USDA. VA is only for our eligible vets. So if you are eligible for a VA loan, please get with our team. We'd love to quote you on that. But since not everybody is eligible, we won't do that live. And same with USDA. If you're looking in an area that's a rural area that it does qualify for USDA, please let us know. We'll quote that up very quickly. But not everybody is looking in those areas. So we'll stick to the top three for now. Let's start with conforming. We'll set up our scenario pretty much the same for every quote. We're going to do a $400,000 loan amount. We're going to do an 80 LTV loan. That's 20% down payment, 80% loan to value. We're going to do a desired price of 99. What that means is we're going to try to find the best combination. The computer's trying to find the best rate at a 1 discount point in cost. So a little bit of cost there. Most of our clients are asking to buy down the rate a little bit. So we're going to look for the most common scenario. We're going to do a conforming loan first. We're going to do purchase, 30-year fixed, primary, single family, 1 unit, Florida, Miami-Dade, since that's where our office is. And for all of our quotes today, we'll do an estimated FICO of 760 and an estimated debt to income ratio of 40. So those are all of our basic settings that we'll have for all of our scenarios. Now let's check out what our rates are this morning. So looks like from yesterday, the rates went up just a tad here. So we have a 6.99 rate for 0.875 in discount point cost. Looks like that's pretty much the best combo the computer found. Possibly could be some better combos. Maybe here a 7% rate for 0.75 in discount points. So please get with our team. They'll find the best combo for you. But this is the conventional options we have this morning. Now let's switch over to typically the next option, which if a customer for some reason, whether it's DTI or credit related or whatever it is, may not qualify for conforming or conventional, typically the next option that we're going to go with is an FHA, which allows us to go a little higher in DTI, a little bit more lenient on the credit guidelines. So typically this is the next option we go with. So let's pull this up, keep everything else the same so we can compare our FHA to our conventional. And it looks like the FHA, I can't remember exactly what it was yesterday, but I think this might be a tad higher than it was yesterday, but we got a 6.125 rate for 0.75 in discount point cost is what the computer found as one of the best combos there. And keep in mind the APR here is 7.023 on this one. That is because there are some additional monthly mortgage insurance costs for FHA and upfront mortgage insurance. But thankfully, the government, the HUD, has just announced that there are some changes coming. So later this month, we'll be able to reduce those MI costs. Some of our programs are already allowing that. So FHA is a very viable option now because of the reduced MI factor that is now applicable. So please get with our team here. I believe this is still taking the old numbers until it officially kicks in later this month, but we should be able to start using the new numbers pretty much right away. So please get with our team. FHA is a great option now that the monthly mortgage insurance has been reduced significantly by the government. Now let's go back and do our final example for a primary home. Typically, if a borrower for some reason doesn't qualify for conforming or FHA, many other banks or lenders do not have any other options. But thankfully here at the Mortgage Calculator, we love to do our non-QM options, and we have over 4,500 loan programs here. As soon as we click this expanded guideline option, that is what we call our non-QM loan programs. So those use alternative income documentation. So we'll keep everything else the same on this quote, but you'll see we have a new option here for income verification. So when we're doing a non-QM loan, we can choose alternative income. We can use 1-year alt doc, 2-year alt doc. We can do asset related, which we did on our show yesterday. If you guys want to watch that episode, we have business bank statements, 12 and 24 months, very popular. Our investor DSCR is what we'll talk about. Jose will talk about here. Our short-term rental options. I'll show some general pricing here in a minute for investments. But our most popular program by far for a borrower purchasing a primary home is typically going to be our bank statement program. So bank statement program for 12 months is going to be for our self-employed borrowers. Typically, they won't qualify for as much as they'd like on their tax returns. So, full documentation for FHA or conventional loans require 2 years of tax returns. Many self-employed borrowers have different write-offs and don't quite show as much income as they should. So we're able to, for self-employed borrowers, utilize their 12 bank statements to determine a debt-to-income ratio based on their actual cash in the bank. So it allows us to typically qualify those borrowers for much more than they would if they are using their 2 years of tax returns. And typically a borrower is able to get that home that they would not otherwise qualify for. So we love offering these alternative solutions and solving problems for our borrowers and essentially qualifying them for their dream home. So let's check out these options. We're going to see the non-QM rates are going to be a little bit higher. But again, these are for borrowers who would not otherwise be able to get this home. So we see an option here up top for 7.625 rate for 1 discount point in cost. So that's a great option. Pretty comparable there to the conforming rates you guys just saw a minute ago, right in the highs 6s and 7s. Now we're in the mid 7s here for non-QM. Very comparable. Many times the non-QM rates are significantly higher than conventional, but right now in this market, I definitely recommend for our borrowers and our team members out there to take advantage of these non-QM programs because they're so comparable right now to the other programs for conventional. If we cruise down here, we might find other options, but you see there's just dozens of programs here under this. Like right here, here's a good one, 7.125 for 0.875 in discount points. So that's actually probably the best price we have there. So there's just dozens of programs here. All these programs do vary. Some of them may allow things like a credit event, like a foreclosure or a short sale or anything like that. So please get with our team. These do vary greatly, and there's just dozens of these programs and flavors of these programs for our borrowers in specific situations. So please get with our team. We'd be happy to quote these up for you and find the exact program that works best for you. Now, before we go into Jose's section here, we always want to do some live pricing on our investment properties. So at the Mortgage Calculator, we love to work with our investors, whether they're a first-time investor buying their first rental property or they're a heavy investor and have 100 plus properties in their portfolio. We have some great programs for any investor out there. Now, let's set this up the same scenario, 80% loan to value, 20% down payment, same 1 discount point in cost, and we're going to compare our conventional investment property programs with our expanded guidelines programs. And in particular, I'm going to do a basic DSCR scenario here. So first we'll start with our conforming conventional, and we'll do everything else the same. Purchase, 30-year fixed, investment property, single family 1 unit, Florida, 760 FICO, 40 DTI, and let's see what the conventional rates are this morning. So as I say every morning, remember the GSEs, Fannie Mae, Freddie Mac, that insure these conventional loans have added an additional, what I would say, penalties for investment properties. So unfortunately, the computer isn't able to find any options for 1 discount point in cost. What it found here was a 7.25 rate for 3.5 discount points in cost, and that's because of those fees. Unfortunately, conventional, we can't go higher in the rate, which some investors don't mind, in order to reduce those discount points just because of that's the way the conventional works, and that's the pricing that the conventional programs have put in place. It's not us, right? It's the government entities that are, at the end of the day, buying these loans. So they put this in place. A lot of our investors are asking for alternative solutions. So many investors don't mind going up in rate if we can reduce the out-of-pocket discount points. However, with these conventional loans, we can't go any higher. So when we go to offer alternative solutions, we're going to look at our non-QM programs. So for our investors that do qualify full doc, no problem. We'd love to send you those quotes. But where we really specialize and where most of our investors take advantage are our expanded guidelines non-QM programs for an investment property. And we'll see here that the option again for income verification pops up for non-QM. And in this case, we can use our investor DSCR income verification. That's our most popular program by far because it actually does not require any income or employment from the borrower. We're simply going to use the estimated rental income from the property in order to determine if that rental income can cover the PITIA of the mortgage payment, right? The expenses there. So typically anything over 1 ratio, we have tons of programs for, but we even have programs for properties that don't quite cash flow for down to like a 0.75 DSCR ratio or even lower, a no ratio. So tons of different options, but we're just going to check out some basic scenarios today. We always have a prepayment penalty pop up on an investment property or a non-QM. All of these are pretty standard at 3 years. Obviously, we can do a 0 option here. That is going to cost more and reduce our loan programs that are available. So for the scenario today, we're going to do a 3-year, which is pretty standard. We could also do a 5-year if the customer was going to hold the property for a long time and doesn't mind having a 5-year prepayment penalty. However, for this scenario, we're always going to do 3 years, which is pretty standard. Now, let's check out our DSCR rates today. So it looks like at the top of the list here, we have an 8.375 option for 0.85 in discount points. So again, our investors a little bit higher on the rate than the conventional, but much lower discount points. So our investors want to save cash typically to invest in other rental properties. So they're asking for these alternative options. And since they're very comparable there, as far as the cost and the rate, obviously they're choosing to do the DSCR much more often, especially because it doesn't require income or employment and they're able to start 5, 10 DSCR loans to cash out 5 or 10 properties to then go purchase 5 or 10 more with DSCR loans. So it really allows our investors to quickly grow their portfolio, especially if they already have properties. They're going to cash out using these programs. So a lot of our investors with multiple properties love these. And as you can see here, we have tons of options with various DSCR values and prepayment penalties and all kinds of different variations and flavors of this program. Oh, here's an even better option, 8.25 rate for 0.475 in discount points. So that's probably our best DSCR program at the moment. But again, all these have different program guidelines. Please get with our team. There's dozens of programs. They'll find the right one to fit you. And that's exactly what we're going to talk about next, where Jose is going to go over to a deep dive and find the program on this list. There's only about 5 or 10 of these programs here that you see here that will allow short-term rental income, which is what Jose is going to do a deep dive on. So we have tons of options, tons of different programs, but please get with our team so they can find which one fits best for you if that specific situation calls for it. So now let me introduce the topic, as Jose will talk about an actual specific situation here that we will use one of these special DSCR programs. So as you guys saw there, we have a ton of programs. The ones that do allow short-term rental, obviously probably a little bit higher there on the rates. You know, that one that you saw that we highlighted with the lowest rate and cost probably does not allow short-term rental income. So you got to get with our team to find which one of those programs will exactly fit. But what Jose has done here is put up a couple scenarios for a short-term rental property and using the various programs that we saw there on the list that do allow us to determine the rental income using short-term rents. So a lot of times when we're purchasing these Airbnb short-term rental properties, the clients love to purchase them. However, it's very difficult to make them cash flow unless we can use short-term rental income. A lot of times the properties will be very, much higher priced because of they're available for short-term rentals. But when we have to use the long-term rental income, it's not going to cash flow enough. So very tricky, but we love to do these. These are probably our number one requested products right now. A lot of the short-term rental investors are still making very good returns, even in this market. So this is a very highly sought-after product and really one we specialize in here at the Mortgage Calculator. So let me go ahead and introduce Jose. Jose's been doing both mortgage and real estate for 27 years, so he has some very unique experience that he can bring to the table on both sides. So that's also why we love to do the DSCR show every Monday. Please, guys, tune into that, where Jose will go into an actual deep dive on an actual property where we can analyze that property. He'll put on his real estate hat and estimate the rents from some of his real estate tools, and then we'll put on our mortgage hat and we'll be able to determine which program is going to work for that exact property. That's what we love about DSCR. Once we have a property, we can determine if that loan's going to work or not. We don't have to wait to see if the borrower's income is going to pass or if we can get the VOE from the employment, right? There's no employment involved at all. All we have to know is that the property's there, and we have to have a very good idea of the rents. So that's really where Jose is going to make or break these deals, is when we're analyzing the rents. Are we going to go long-term? Are we going to go short-term? And how does that work? So Jose, can you kind of introduce the topic, and then I'll go ahead and share your screens?
Absolutely. Good morning, everybody. Thank you for joining us. Jose Gonzalez here. DSCR, obviously our flagship program. We've been DSCRing, if I can invent that phrase, for almost 4 years now. I definitely liked our foresight that we had when we implemented that as one of our main modus operandi here at the Mortgage Calculator, because we like to think of all of the outside the box solutions to typical everyday situations, right? It's outside the box, but it's not an outside the box problem. It's an everyday problem. And we figured that out a long time ago. So that's why with the debt service coverage ratio program, which is what DSCR stands for, it is basically an actual calculation, even though we've come to use the term like Band-Aid, give me a Band-Aid, give me a Coke, we'll do a DSCR loan, but it actually does stand for debt service coverage ratio, which is determined by dividing the gross monthly rent by the total housing expense. And here, housing expense, we're talking about PITI and, if applicable, association fee. Now, how you reach that gross market rent is what varies from program to program, because not every DSCR loan is created alike, right? They all have, all of the different programs have different tweaks to what is acceptable and what is not acceptable to calculating the actual income for the property. There's no such thing as on a DSCR loan, how do you calculate the income? No, it's on a DSCR loan for XYZ program option. How do you calculate the rate? Then we look at the guidelines and we see what is acceptable. It could be in some cases they're strict, lease only. Other cases, 1007 long-term rent only. Other cases, they say, well, we'll use a 1007 or short-term rental revenue reports or a lease, whichever you basically give us, right? But all of the appraisals are going to be ordered with a 1007 as a requirement. There's no way to get around a 1007 on the appraisal. We have to be aware of that. So that's going to be something that you have to deal with. What is going to get put on that 1007 is where we can get creative and try to make it work, especially now with the short-term rentals, when we analyze what the actual program entails. So normally we like to go for the option that's going to give us the most flexibility in the 1007 calculation, which means we want the option that allows us, for example, to use AirDNA, which is projected income from a short-term rental. So that is a possibility that went away at the onset of the pandemic when they tightened the guidelines a little bit, but they've loosened it. As Nick was mentioning, non-QM is hungry. They have an appetite for loans right now. That's why you're not necessarily seeing a direct correlation between what's happening in the rates in the agency world with what's happening in the rates in the non-QM world, which is a Wall Street driven product. If there's more money available, they will loosen guidelines to get more loans. And I believe that is where we are right now, which is what makes non-QM so exciting. And then when we get to non-QM and short-term, DSCR and short-term rental income, it gets even more exciting when we can provide these solutions. So that's why it's so important to make sure that the loan is off on the correct trajectory from the beginning, with a proper assessment of what exactly are you dealing with here in the 1007 scenario. So if you have a situation where your borrower says, this is short-term rental, this is what I'm going to be doing, or this is what I am doing, then you got to find the solution, which we have. So I have here 4 examples for us today. I have 3 purchase examples, and I have 1 refinance example, just so you can see it is possible. Now here in the first example, I guess I would call this the DSCR unicorn, right? 85% LTV on a purchase, allowing short-term rental income. Now in this scenario here, we're talking about allowing AirDNA projected income calculations, as well as, depending which is more advantageous to the deal, allowing property revenue reports from a portal like Airbnb, HomeAway, VRBO, or all of them. If they have the property on multiple platforms, you get multiple revenue reports, add them up. There's going to be some kind of a haircut, an adjustment, maybe 70, 75, 80% of that amount is what they let you use, and that's your income. However, yes, it is an 85% option, but if you use short-term rental income to qualify, there is, for this example, a 5% LTV reduction. So you say, why would I want to use then this option if there's a 5% LTV reduction? Well, here's a great reason why. What if there are no short-term rental revenue reports for the property from the seller? Either they're not providing them, not available, whatever it is, and you have a property that's at a certain price that you need those true AirDNA comparables, right? So then it makes sense, if you're going to get, in this case, an 80%, with a really high DSCR, which is what you need. Maybe you'll capture at 1.25, maybe you'll capture at 1.5 and you'll better your rate, but this is what you need. So for the property where you need AirDNA in order to make the numbers work, then this would be the option you would choose. And mind you, it wouldn't be 85, it'll be adjusted down to 80, but it's still a very good option because this is the highest LTV that you're going to get and still be able to use AirDNA, which is a projected short-term rental income for that property, where there's database from us, every property Airbnb is hosting in that area, and they're going to provide that data on what they're renting for. It's sort of like doing comps in the multiple listing for rentals when you're a realtor, except this is for short-term rentals, and the database, instead of being the MLS, is Airbnb, right? They just market it through AirDNA. So again, very good reason to use the AirDNA, even if you do get a 5% LTV hit. And look at those rates. You're looking at 9.25 being the lowest cost option to 8.75 being the highest cost, lowest rate option, right? So in this case, a little bit, just almost 2 points. I think it's 1.875 at 9.25, and it's just about 3 points at 8.75%. So again, DSCR, AirDNA, in this case, you'd have found the pot of gold at the end of the rainbow. So now I give you another example just so you could see the rate difference for the same product. This case, though, at an 80%, which remember, 80% becomes 75 here. So this is effective only if you need to use AirDNA. If there aren't any revenue reports available, then you would go this route. And I'm going to show you in a minute why, because I have another option for short-term rental without AirDNA, without an LTV adjustment. But that one only goes max to an 80. So 80 is all you're going to get. But in this case, if your borrower is fine with a 75, you price it out at the 80% option, and then there's going to be a 5% LTV adjustment, but the pricing will be the 80% pricing, right? So 8.499, really good option here, right? That's like very little on the cost there, almost a half a point only on the cost. And then you can buy it down all the way to 7.375 at a cost of about 2.875 points. So now we have another option. This one will be actually 80% with no adjustment. This one does not allow AirDNA, but does allow for the use of short-term rental revenue reports, again, without an LTV adjustment. So you will look at the great rates here. If we're looking at 80%, you'll know if I go to our other option that ends up being 80%, which is the 85, that one was 9.25 at a cost of almost 3 times what this option is. So, in a regular scenario where I say regular because there's nothing regular about short-term rental deals, but in the traditional scenario, let's say when you're not needing AirDNA, we're just using the property revenue reports either provided by the seller of the property, or if it's a refi by the owner, then you would have this option, which is a regular DSCR option. It's just one of our programs that allows short-term rental income to be calculated by revenue reports. They do hit you with a haircut. I believe in this case they go with 70% of whatever the revenue report comes up with, but that's still going to usually give you better income than long-term rents with no adjustment. And then our final option is a 75% LTV cash out refi. So this would be the same program option that I just described right now, where it allows use of the short-term rental revenue reports, but not AirDNA, to get 75% loan to value. The other option is available using the AirDNA, but with the LTV adjustment, that's going to get you down to a 70% LTV. So this is a very good option. And typically, if it's a refi and they've been doing short-term rentals, because you cannot use AirDNA, by the way, I should back up a minute and not confuse everybody. You cannot use AirDNA for refinances. AirDNA is for projected income only. So once you own that property, the only way to capture the short-term rental income will be one of two ways, either short-term rental revenue reports or another unicorn, having the appraiser actually find short-term rental comps and actually put them on the 1007, and we do get those every now and then, so it is not an impossible task. Actually get the short-term rental comps put on the 1007. At that point, it's comps on a 1007, documented, and they will take it. So that's multiple scenarios to resolve your outside the box, no lease properties, because that's another thing. When you're sizing up these deals, if the option says in their guidelines you need a lease, or else they're not going to do the deal, or they may actually do an LTV adjustment on you. So please pay close attention to all of those requirements.
Perfect. Thank you, sir. All right. Well, we appreciate everybody tuning in. We have some amazing programs, as Jose just went through, all the way from conventional to things like this, special non-QM products. We specialize in providing programs for investors, which this is one of the great options for them as well. So if you're looking to do a loan, get linked up with one of our loan officers. Maybe one of our loan officers shared this video with you. Go ahead and get with them. They can send you an instant quote like those quotes that Jose had pulled up right there. Our loan officers can send those to you within just a few minutes. If you're not working with one of our loan officers yet, please visit us at themortgagecalculator.com and we can link you up with one of our loan officers. We are licensed in 21 states. We have over 350 loan officers across the country, and these DSCR business purpose loans we can do in most states. So definitely check us out, themortgagecalculator.com. We can pair you with one of our loan officer consultants that can not only do those regular conventional FHA, USDA, VA loans, but also these more complicated transactions such as the DSCR loans and the ones involving short-term rental income as well. So themortgagecalculator.com, come visit us. We do this show every weekday at 11 a.m. Eastern time. So definitely tune in. We hope to see everybody tomorrow. Thank you for tuning in. We'll see you tomorrow at 11 a.m.
Thanks, everybody.